In our today's video we are going to learn the basics of value investing and how can we identify undervalued stocks. So let's go. Value investing is an investment strategy that involves identifying and purchasing stocks that are trading at a price below their intrinsic value. The core principle of value investing is to buy stocks when they are undervalued by the market and hold them for the long term, expecting the market to eventually recognize their true worth and drive the stock price higher. Here are the basics of value investing and how to identify undervalued stocks. Basics of value investing. 1. Intrinsic value. In value investing, the focus is on determining the intrinsic value of a stock, which represents its true worth based on the company's financials, assets, earnings, and growth prospects. 2. Margin of safety. Value investors seek a margin of safety when purchasing stocks. This means buying stocks at a significant discount to their intrinsic value to protect against unforeseen risks or uncertainties. 3. Long-term perspective. Value investing is a long-term strategy. Investors are willing to wait patiently for the market to recognize the true value of the stock, which may take time. 4. Fundamental analysis. Value investors rely heavily on fundamental analysis. They assess a company's financial statements, earnings, cash flow, competitive position, management, and industry outlook to determine its intrinsic value. 5. Contrarian approach. Value investing often involves taking a contrarian approach, meaning buying stocks that are out of favor with the market or in industries that are temporarily facing challenges. Identifying undervalued stocks. 1. Price to earnings ratio, PA. A low PA ratio relative to the industry or historical averages may indicate that a stock is undervalued. A lower PA ratio suggests that the stock is trading at a lower price relative to its earnings. 2. Price to book ratio, PB. The PB ratio compares a company's market value to its book value, assets minus liabilities. A PB ratio below 1 could indicate an undervalued stock. 3. Dividend yield. A high dividend yield relative to historical averages or peers might suggest an undervalued stock. However, consider the sustainability and growth potential of the dividend. 4. Free cash flow. Positive and growing free cash flow is a positive sign for value investors. It indicates that the company generates excess cash, which can be used for dividends, share buybacks, or reinvestment. 5. Competitive advantage. Look for companies with a durable competitive advantage or a moat that protects them from competitors. A strong competitive position can contribute to long-term value. 6. Debt levels. Evaluate a company's debt levels. Low debt or improving debt ratios can indicate financial strength and could point to an undervalued stock. 7. Management quality. Assess the quality of the company's management team and their track record. Strong leadership can drive long-term value creation. 8. Industry and market sentiment. Consider the broader market sentiment and industry outlook. Undervalued stocks may be found in sectors facing temporary headwinds. It's important to note that value investing carries risks, and not all undervalued stocks will necessarily perform well in the future. As with any investment strategy, diversification and thorough research are essential. Value investing requires patience, discipline, and a long-term perspective to potentially reap the rewards of undervalued stocks that eventually gain recognition and appreciation in the market. If you learned something valuable from this video, make sure to press the like button and hit that subscribe button.